This is for educational purposes. There's nothing being solicited. I am a investment advisory representative with Financial Network Investment Corporation, and securities and investment advisory services are offered through Financial Network Investment Corporation. So these are the strategies, and this is 4 of the strategies that we see most commonly used. There are others. Strategies for managing risk, risk being volatility, okay? And we're going to look at this in the context of the fact that, you know, we're leaving a market cycle. We're kind of past a cycle where whatever you wanted to buy in the stock market is cheap. So the first that we hear a lot about is staying in cash or market timing. I'll make a couple comments about these 2 issues. If you stay in cash, it's a known certainty that you will lose purchasing power in the end. Okay? If you put your money in the mattress, bury it in the backyard, put it in the bank, earn 1% or 1 1/4 and pay tax on it, it's not a guess as to whether or not you will have more or less spending power. You will have less. Okay? We know that. You may invest it in something and lose more, but there's an opportunity that you might not lose more. So it's sort of saying, I've got 2 outcomes. I'm either going to lose purchasing power for sure, or I'm going to do something different, and then that something different, I might lose purchasing power if I make bad decisions, or if I have success, then I'll have the ability to outperform inflation. So I don't advise staying in cash. However, that being said, there is a place for cash, and it's a very important place in our strategies, and that is that it's savings. It is very critical that you maintain a savings account that can cover 3 to 6 months of your household expenses if you have a single employee breadwinner, and probably 12 to 18 months if you have 2 breadwinners. Because if you think about the time to get reemployed that we're experiencing today, it's taking the average reasonably paid person 6 to 9 months to get back into a job that's even remotely in the same pay range as what they were before. So if you've got 2 contributing incomes, you can probably get away with 6 to 12 months of your expenses in savings in cash, something that's not going up and down. And if you've only got 1, it probably needs to be 12 to 24 months, depending on your job security, which we all have less job security now than we had 5 years ago, because companies are very more willing to cut costs and try to bring their bottom line up much more than they used to be. But that's the use for cash. It is not an investment. Market timing, what I'll tell you about market timing is this. We fundamentally don't do it. We just don't believe that it has any statistical, there's no statistical accuracy. It doesn't work. It may work for a while with a certain strategy, and then all of a sudden you never saw it coming and it doesn't work and it hurts you in a big way. But with market timing, you got to think about this. You have to make 2 very difficult decisions and get both of them right. When the market's turning down and it really feels uncomfortable, and you're thinking, man, I should probably get out of the market, I can't lose money, then you have to make the decision to get out of the market. And that's a tough decision, because we know that in the end, stocks over 20 years, 30 years, 15 years always end up. So you're saying, I'm going to come out of something that is sort of a known that in the end typically will land on the upside, but I'm going to make the decision, I'm going to come out. So that's decision number 1. Decision number 2 is that you have to make the decision to re-enter the market when things are far worse than they were when you got out. That's the hard one. You know what I mean? For it to ultimately work, you have to have bought low and sold high, which means on the back end of that you have to have gotten out before things went down a ton, and you had to have the discipline, the patience, the long-term vision to say, now things are super cheap and I want to get in. And you have to make a bold move to do that. And it's just very, very rare that people actually do that. So we subscribe to a different way of managing risk because we don't find that people can do it successfully.
The S&P 500 index is a widely recognized measure of the U.S. stock market performance. It is an unmanaged index of 500 common stocks chosen for market size, liquidity, and industry group representation, among other factors. The Barclays Capital U.S. Aggregate Bond Index is an unmanaged index that covers the U.S. dollar-denominated investment-grade fixed-rate taxable bond market of the SEC-registered securities. The index includes bonds from the Treasury, government-related, corporate, mortgage-backed securities, asset-backed securities, and collateralized mortgage-backed securities sectors. Barclays Capital U.S. Intermediate Government and Credit Bond Index is an unmanaged index that includes U.S. Treasuries, government-related issues, and investment-grade U.S. corporate securities with remaining maturities of 1 to 10 years. Barclays Capital U.S. Long Government Credit Bond Index is the long component of the Barclays U.S. Government and Credit Bond Index and is widely recognized index which features a blend of U.S. Treasury, government-sponsored, U.S. agency, and supranational mortgage and corporate securities limited to a maturity of more than 10 years. Barclays Capital U.S. Corporate High Yield Bond Index is an unmanaged index that covers U.S. dollar-denominated, non-investment grade fixed-rate taxable corporate bond market securities. Citigroup 1-month Treasury Bill Index measures monthly return equivalents of yield averages that are not marked to market. This index consists of the last 1-month issues. Returns for this index are calculated on a monthly basis only. The Consumer Price Index is an inflationary indicator that measures the change in the cost of a fixed basket of goods and services, including housing, food, electricity, and transportation. The Sharpe ratio is a measure of historical adjusted performance calculated by dividing the fund's excess returns by the standard deviation of those returns. The higher the ratio, the better the fund's return per unit of risk. Investors cannot invest indirectly into indexes. The performance of any index is not indicative of the performance of any investment and does not take into account the effects of inflation and/or fees and expenses associated with investing.